Good day, everyone. My name is Ted Gardner. I'm one of the portfolio managers here on Westwood's energy infrastructure team. Today, we're just going to talk about a few of the things that transpired during the month of August. Looking first at monthly performance, it was a relatively flat month for energy infrastructure. The AMA was down 12 basis points, AMEI was down 50 basis points, and the MLP only AMZ benchmark was actually up 47 basis points. This brings year-to-date performance to 7.8% for AMA, 10.2% for AMEI, and 16.8% for AMZ. Broader energy equities outperformed energy infrastructure a bit, with the exception of clean energy that was hit very hard due to lower expectations on several of the solar names due to some inventory destocking and other issues that arose during the second quarter earnings season. Commodities were strong, with oil rallying over 2%, gas up just north of 5%, and global LNG prices rallying over 20%, mostly due to supply concerns from pending Australian LNG strikes. Breaking it down into buckets, U.S. C Corps were down 3.4% on average, but that was dragged down quite a bit by Tellurian's 35% decline. MLPs were up 80 basis points on average, and Canadians were up 10 basis points on average. Year to date, C Corps are up 7.2% on average, led by Equitrans, which is up over 50%. MLPs have meaningfully outperformed at 14.3% due to returns in the high 30% range from both Magellan and Plains, and Canadians have been a drag of only 60 basis points on average. In terms of news for the month, Energy Transfer announced the acquisition of Crestwood during August, which, following the Magellan 1.0 transaction earlier this year, has led to the question, is a consolidation made funds? And our answer to that question has been the same for about 16 years now that we've been doing this, and that is that it's very difficult to predict corporate level M&A. Magellan and Crestwood both had similar reasons for selling their companies at this point. They both stated that they felt their long-term standalone growth opportunities were dwindling and felt that their shareholders would be better off in a stronger and larger footprint. Realize, however, that not every company is in that position. But beyond these two transactions that have been announced, there are certainly a few names that look like they would be a good fit when you take a look at their asset maps. But again, it's hard to predict what, if anything, will happen in those cases because you have to have the financial metrics work, you have to not have any meaningful regulatory issues, etc. One thing we are confident about, though, is that private transactions will continue to take place. We saw Gibson Energy buy Buckeye's Corpus Christi oil export terminal earlier this summer. Energy Transfer bought private equity-backed Permian system Lotus Midstream earlier this year. And then just last week, Western Midstream announced the acquisition of Powder River Basin assets from private equity-backed Meritage Midstream. There have also been some asset divestitures from some of the public companies in order to address balance sheet leverage issues. Two of the more notable transactions have been TC Energy selling a 40% stake in Columbia Gas Transmission for 5.2 billion Canadian dollars. And Enbridge just announced the $14 billion acquisition of Dominion Energy's gas utility business, which Dominion had to sell in order to leverage. The transaction multiples have been quite reasonable, which is great if you're a buyer, but not so much if you're a seller. TC Energy stock declined after their sale announcement as the street was expecting a higher price for such high quality regulated assets that they sold for 10.5 times. Dominion also took some heat for selling their assets, which were also high quality regulated assets at lower than expected multiple. So why are multiples low? The easy answer is higher interest rates. On this slide, we show some quick and dirty math on multiples and use the TC Energy asset sale as an example. Our inputs are 5 times leverage on the acquisition since they are high quality assets, a 6.25% interest rate, which is where we see the 10-year debt of most of the large cap investment grade names trading today, and a 12.5% equity return hurdle, which is what we felt investors would target on an asset of this quality. That gets us right to the 10.5 times multiple that TRP received on the transaction. Now, if this transaction took place not too long ago when rates were closer to 3%, a buyer could have paid up to 11.8 times and still generated that same 12.5% equity return that we show in the example on the right of the slide. So the bottom line is that higher rates lead to lower multiples, all else equal. From an industry perspective, we believe that high cash flow, cash-rich energy infrastructure companies remain in a strong position to acquire assets and expand their footprints at reasonable multiples. Thanks for listening today. Please contact your Westwood representative with any questions.